Welcome back to Geojit Spotlight. The Indian markets have seen significant choppiness recently, driven by global tariff threats and FII selling. What does this mean for your portfolio? To break down the macro picture and give you a rock solid portfolio strategy, we welcome Geojit's Research Analyst, Mr. Antu Eapen Thomas. Welcome, Mr. Antu.
Thank you, Bintia.
So, Antu, what caused the recent market fall and which types of stocks were affected the most?
The recent fall of the market is largely triggered by IT and pharma stocks. Both would account for about 15% weight of broad Indian market. The IT index came under early pressure amid concerns over rising H-1B visa cost, compounded by the recent Accenture's subdued outlook. Sentiment weakened further as fresh 100% US tariff on pharmaceutical products led to a sharp sell-off in pharma counters. Mid and small cap stocks corrected more sharply than large caps on a YTD basis, reflecting stress from their stretched valuations.
How will the increase in H-1B visa fees affect Indian IT companies?
The $1 lakh H-1B visa fee hike in the US is expected to impact Indian IT companies in the short term in nature, prompting a shift towards increased local hiring, subcontracting, and offshore delivery. While large firms are better equipped to absorb these costs, mid-tier companies reliant on fresh visas may face margin pressure and project delays. This change could accelerate IT investments in global capability centers, that is GCCs, automation, AI, and geographic diversifications into EMEA and Asia Pacific regions. And given the quality strength of the IT business model, the long-term effect can even reverse profitable by increasing offsite, offshore, and pass-through of expenditure. We think it is a good time for long-term investors to invest in these sectors with an accumulation strategy.
Okay, and to how is proposed US tariff on pharmaceutical products impacting the Indian pharma industry?
The proposed 100% US tariff on branded and patented pharmaceutical products are said to impact manufacturing facilities in South Korea, the UK, Ireland, and Switzerland. Though countries with US trade agreements like the UK, EU, and Japan are exempt. That way, Indian pharma sector bearing the effect as trade discussions continues. While plain vanilla generics remain unaffected for now, which is the major business of India export. Indian CDMOs could lose competitive unless they have US-based facilities. However, the deal made by the Pfizer with the US government to provide discounted branded products directed through its website has temporarily eased the pressure. Much more deals are expected, which could reduce the US plan on price control. In overall, the impact on domestic is limited since 90% of US market is generic, which is a 40 of pharma India, and many are planning to increase manufacturing in the US.
And based on the current outlook, what is the recommended portfolio allocation for investors?
Despite trade tensions and geopolitical risk, RBI upgraded our FY26 GDP growth forecast to 6.8%. It is basically the domestic triggers are favoring, like reduction in GST rates, easing inflation, and a rate cut by the RBI is giving a sense of a good kind of growth for FY26. We proposed a balanced investment portfolio with 70% allocated to equities, 25% to bonds or debt instruments, and 5% to gold. Due to a drastic increase in gold prices, we cut the weight from 10% to 5% currently. Equities are expected to remain buoyant over the medium term, supported by fiscal policies and in anticipation of a reduction in future trade risk. However, global headwinds, lack of high earnings growth, high valuation is impacting current equity trend.
Is foreign institutional investor selling still a major concern for the Indian market, and what is the outlook for FII flows?
FII Sellings has been the biggest issue for the underperformance of India compared to the rest of the world. Meanwhile, the latest 25 basis point interest rate cut by the US Federal Reserve and expectations of further cut during the year is likely to weaken the dollar and enhance the FII's inflow into emerging markets like India. Immediate business benefit may be limited, but the move support future sentiments and reduce downside risk. Secondly, India equities are likely to benefit due to drastic drop in premium valuation to emerging markets. Though expectation on Q2 earnings is average, Q3 results is likely to be start a better growth trajectory led by fiscal stimuluses. All these factors would decide a reversal in FII's inflow going forward.
And considering the potential GST cuts and recent IT sector fall, what is a key investment theme for the next 12 to 24 months?
Over the next 12 to 24 months, domestic investment themes are poised to deliver strong returns, driven by reforms such as tax cuts, lower GST rates, easing inflation, and potential rate reductions. These factors are expected to boost disposable incomes and consumptions, benefiting sectors like automobiles, consumer durables, real estates, and FMCG. Infrastructure also remain a promising theme, supported by government's capex and modernization efforts, while emerging sectors like data centers and green energy offer additional opportunities. The IT sector, despite current challenges, presents a contrarian opportunity for long-term high-risk investors, especially stronger as further Fed rate cut materialize.
And all our viewers, we hope these insights from Mr. Antu Eapen help you navigate the coming months. Don't forget to like this video, share it with your investor friends, and subscribe to Geojit Spotlight for more expert market analysis. We'll see you next time.